From a guy who pays tax before he's even touched his own paycheck, to a guy who's legally never paid tax on a single dollar of his net worth ever. There's apparently no limit to how creative you can get with the word income once you have enough of it. The wild part? The richest guy on this list has probably never opened a tax app in his life. I'd trade my accountant for his lawyer in a heartbeat. Level 1. Level 1 is the version of taxes you already know, personally, intimately, against your will. A salaried employee, tax withheld from every paycheck automatically, before the money even technically becomes his. He pays an effective rate reportedly in the 20 to 30% range, depending on the bracket. The IRS doesn't ask him for the money. It simply never sends it to him in the first place. He's also technically allowed a small number of deductions, a retirement contribution, maybe a student loan interest write-off worth a few $100s a year. The buyer is a high school teacher who spends 40 minutes every April itemizing a home office deduction worth about $11, while somewhere else in the country, a man worth $40 billion is filing paperwork that will, legally, result in roughly the same number. Here's what nobody tells you at this level. You're not avoiding paying tax badly. You're just the only one in this story who was never given the option to avoid it at all. Level 2. Level 2 is a small business owner or real estate investor, someone who's discovered that a business can lose money on paper while making money in real life thanks to depreciation, a deduction that lets you write off an asset's declining value even while the asset itself is quietly appreciating. An investigative analysis of leaked IRS records reportedly found that the 25 richest Americans saw their collective wealth grow by over $400 billion across several recent years while paying a true tax rate, taxes paid divided against wealth growth rather than reported income, of around 3.4%. A public school teacher, in the same analysis, reportedly paid a true tax rate several times higher on far less money. The buyer is a landlord who reports a net loss on a building that's currently worth twice what he paid for it. Depreciation was reportedly written into the tax code originally to help ordinary businesses recover the real cost of wearing out equipment, a delivery truck, a factory machine, something that genuinely loses value over time. Real estate simply borrowed the same clause and applied it to buildings that, empirically, tend to go up in price, which nobody bothered to fix because the people benefiting from it were also, occasionally, the people writing the fix. The most valuable thing you can own, tax-wise, isn't an asset that makes money. It's one that's legally allowed to pretend it isn't. Level 3. Picture this. A billionaire sits in a lawyer's conference room, signs a single document, and moves $100 million in company stock into a trust that will, on paper, pay him back almost exactly what he put in, plus a token government interest rate over the next 2 years. If the stock does nothing, he loses nothing. If the stock doubles, which is the entire bet, everything above the original amount passes to his kids, tax-free. This is level 3, a strategy commonly called a GRAT, a Grantor retained annuity trust, legally structured so that if it fails, nothing happens. And if it succeeds, a fortune changes hands without the estate or gift tax that would normally apply to a transfer that size. The lawyers who structure these reportedly charge fees that sound enormous in isolation and microscopic against the transfer size, a few $100,000 to potentially move tens of millions tax-free. It's the only wealth strategy in existence where the downside is absolutely nothing happens, and the upside is your children inherit a small country's GDP without a form to fill out. Because from level 4 onward, this stops being about clever paperwork. It starts being about rewriting where the money legally lives in the first place. Level 4. This isn't a new hobby. The Rockefeller family reportedly established one of the first modern family offices back in the 1880s, an entire private organization built to manage the family's fortune across generations. Tax strategy included. Decades before wealth management was a phrase anyone used in public, that structure never went away. It multiplied. Level 4 is the modern descendant of that same idea. The buyer isn't an individual. It's a 100-year-old institution with a mission statement nobody outside the family has ever read, employing more lawyers than most small law firms, dedicated entirely to a single balance sheet. Family offices have reportedly multiplied dramatically over the past 2 decades, to the point where thousands now operate globally, most of them intentionally invisible, with no public filings, no employer reviews on job sites. The Rockefellers weren't hiding money. They were simply the first people rich enough to realize that permanence itself was the loophole and that a strategy patient enough to outlast a single presidency would eventually outlast several. Level 5. The life insurance industry has sold one product for over a century, a payout when you die, designed to protect your family from the financial shock of losing you. Level 5 uses the exact same product to do something the industry never advertised. Private placement life insurance lets a wealthy buyer wrap an investment portfolio inside an insurance policy, where it reportedly grows completely tax-free and passes to heirs tax-free, provided the money technically never gets withdrawn as a taxable distribution while the policyholder is alive. Nobody's protecting a grieving family here. They're using a mortality product to shield a stock portfolio from a tax collector who was never invited to the meeting. The buyer is a hedge fund manager who reportedly holds tens of millions of dollars inside one of these policies, growing quietly. Regulators have reportedly scrutinized this exact structure for years, precisely because it stretches a law meant to protect widows and children into something closer to a tax-free brokerage account, with a mortality clause bolted on for legal cover. The insurance company still technically has to pay out if he dies. It's just that, financially, dying was never really the point of buying it. Life insurance was built to protect you from an early death. This level uses it to make sure an early death is, financially, the single most efficient thing that could possibly happen to the portfolio. Level 6. At this level, the money doesn't just change structure, it changes address. Puerto Rico's Act 60, a tax incentive program, reportedly lets qualifying new residents pay zero federal capital gains tax on investment gains earned after they relocate, a legal structure that requires spending a significant portion of the year physically on the island and severing enough ties to the mainland to qualify. Crypto investors and hedge fund managers reportedly relocated in meaningful numbers once this became widely known, timing the move specifically to land before a major liquidity event, a sale, an IPO, a token unlock, so that the resulting gain gets taxed at the destination's rate instead of the one back home. The buyer is an early crypto investor who reportedly moved to San Juan 18 months before cashing out a position worth 8 figures, calling it a lifestyle change. Local residents and economists in Puerto Rico have reportedly pushed back on the program for years, arguing it drives up housing costs for people who were born there, while contributing relatively little in return, an entire island effectively functioning as a very scenic tax bracket for people who can afford the flight down. Nothing about this level requires hiding money anywhere. It just requires being willing to physically relocate a body to wherever the number on the tax form gets smaller. Level 7. Combine everything so far, the low-interest loans against stock that never technically counts as income, the trusts, the insurance wrapper, the relocation, and one rule sits underneath all of it, quietly doing the heaviest lifting in the entire tax code. When someone dies, their heirs inherit assets at current market value, not the original purchase price, a mechanism called step-up in basis. Every dollar of capital gain that accumulated across an entire lifetime simply resets to zero, legally, permanently, the moment the person holding it dies. It's the oldest move there is. Buy an asset, never sell it, borrow against it instead, tax-free for the rest of your life, then die and let the gain vanish on paper the same instant it would have finally become taxable. Congress has reportedly proposed closing this exact loophole multiple times over the past 2 decades, taxing unrealized gains at death instead of resetting them, and it has reportedly failed every single time. At every level below this one, you were looking for a clever way to reduce the bill. At level 7, the winning move was never paying it. So next time someone tells you the wealthy pay their fair share, they're technically not lying. They're just extremely, expensively good at deciding what fair means before anyone else in the room gets a vote. 7 levels, and the tax code never once had to be broken. The teacher from level 1 and the founder from level 3 are, on paper, following the exact same tax code. One of them just had the option to treat it as a suggestion, and the other never got past the withholding line to find out it was negotiable at all.